Well, we love talking with you about our ag commodity markets. I'm Marlon Bowling, your tour guide to the ag commodities. Well, today we had no news from USDA as far as overnight export sales, so we'll see what else we have to trade on here this morning. I want to welcome aboard Brian Hoops, president of Midwest Market Solutions, so we can talk about our setup for today's market activity, and he joins us right now. Brian, let's take a look at our overnight trade. With no overnight sales to offer any kind of guidance today, I want to look at the overnight corn market here with the quotes provided by bar chart. Now, on the corn, we have December 2 1/4 higher this morning at 539 3/4, so a little bit of strength over here. In the soybean market, just very slight strength. We have November 1 3/4 higher. We're at 1252 1/4. And in the wheat market here overnight, we had the Chicago contract on the December 5.5 cents higher at 750 1/4. Now, remember yesterday, Kansas City wheat was struggling relative to the other two wheat exchanges. Well, overnight, it's 6 1/4 higher on December at 747 1/4. Now, on Minneapolis wheat overnight, we had the December contract 8 cents higher at 933 1/2. And of course, we were talking earlier about that juggernaut yesterday with the cotton. Cotton was 4 cents higher yesterday, 400 points higher in limit moves, and overnight it went 5 cents higher. Look at the prices here. December cotton, 113.93 per pound on the cotton. Just phenomenal increases here in price. And just wondered, Brian, from your perspective, we were talking before we came on the air about the fact that we also had a huge move higher in the energy prices in Europe. Now, for example, in Britain, what was it? They went up, I believe, 40% just overnight, I believe, in their energy prices. Something to keep an eye on. That could have a spillover impact here in the U.S., especially if they have the Green New Deal that they vote on. Here's something I wanted to point out for you, and I want to get your input on this here, Brian. Here is what we're looking at. We're looking at a spread chart of December corn. This would be your blue line up here, current December corn, and the red December corn, that would be for next year down here in the yellow if you're watching at home. But look how the spread has widened out. This is where it was back here earlier in the year, very, very wide. And now it is coming together, and now it's almost matching. This is the current December right here, and next year's December right there. Now let's look at soybeans, November to November. And on the soybean chart, here we go, where it's, again, now this is all kind of has to be in scale. But anyway, again, it was very wide here earlier this spring and summer. And now it has gotten to the point where it's only 2 cents apart between the November now and the November next year. I believe it's something like 2 cents. Brian, what do you make of all that? What is the market trying to tell us?
Yeah, Marlon, good morning. So these charts that you're showing us are really interesting, and what we've seen from a fundamental standpoint is back in the spring time frame, the new crop, this year's crop of corn and soybeans had a lot of variability, a lot of uncertainty about prices, and prices were much higher than what they are currently. Now that we've gotten closer to harvest, we know approximately what the yield is going to be. It's in the 170 range. We just don't know if it's a little bit above or a little bit below what the USDA said in September. We don't have that huge variability that it could be in the 160s or even in the 180s that we saw in the spring. And now we're looking at higher energy prices, as you mentioned, higher fertilizer prices. That is pushing new crop corn futures. And we talked about the red contract, the December 22. It's pushing that market even higher and higher to where it's almost on par with this year. And that's, a lot of times you don't have a premium. Sometimes you have a discount. But this year, it looks like it wants to build in a little bit of a premium. And that's because the uncertainty of how many acres will get seeded next spring. Our ending stocks are somewhat tight, but unless we continue to grow acres, they're going to get very, very tight next year. And that's the concern that the market is starting to price in already, is building a little bit of a premium, maybe encourage some South American production. have the U.S. producers lock in input costs so that they're kind of locked into their acres for next year. And also you have wheat prices moving higher. So, there's a competing grain there with oats, with wheat, corn. All these markets could be added to acres next year, depending upon what happens with the fertilizer prices.
I just wanted to point that out, and it may serve our viewers and listeners out there to check with their local elevators and see just what kind of a bid they can get for the new crop for next year in 2022 at this point, with everything tightening up the way it is right now. Brian, we'll come back in a moment. We'll talk about our livestock trade here on a Wednesday morning when we come back. Well, we're back, and we're talking with Brian Hoops. Now, he is with Midwest Market Solutions. He's based in Springfield, Missouri at the headquarters. So what do you see happening in our livestock trade today? What's the setup trying to tell you?
Well, the last couple of days, we've seen some unwinding of cattle and hog spreads, with hogs being sold and cattle being bought back off of their lows, off of some weekly support. That rally kind of fizzled by the end of the day as cash trade developed more of a steady type feel and pulled October, December off of their highs, closing near the session lows. So we may have a little bit of follow through selling or some cleanup sells there, but it does certainly look like probably more in that 122 range, maybe 123 this week, instead of the upper end 124, even 125 for cash cattle. So that keeps the lid on rallies in October. The deferred contracts may want to try and move higher, building in a little bit of a premium. And if they do, producers really need to continue to look at hedging opportunities. We were talking about hedging December when it was in that 135 and above range as we were making new contract highs because of concerns about the economy and concerns about COVID and those cases rising. But you also look like we're going to have probably very heavy placements of cattle coming up here over the next several months, and that could limit any upward mobility on some of those deferred cattle contracts. So, if we get a big rally, get some good pricing opportunities, I would not be afraid to, at a minimum, buy some put options and lock in at least a break even or some downside risk management.
So yesterday when we finished up, we were 20 cents higher. That was on that October contract on live cattle. The December was down 20 cents, so kind of a wash there on the nearby contracts. 127.85 was our last trade there, but all the deferreds were a little bit firmer. On the feeder cattle trade yesterday, when we wrapped up the session, everything over $1 higher. And for example, you had November up $1.85 at 156.87. Meanwhile, lean hog trade yesterday when we went home, we had that December contract 55 cents lower at 82.55, and we'll see where it wants to go today. Brian, thank you so much for all the analysis this morning. Good to visit with you again. Brian Hoops, Midwest Market Solutions. Tammy, I'll turn it back to you.